Hello there, Bloke here, and we are going to talk about Thungela resources. So this is an article that I'm going to be releasing in the next day or so, and just kind of quickly work through it. So Thungela is currently at £3.59, listed in South Africa, listed in London. Um, it's been on a bit of a roller coaster ride. It owns 6 mines in South Africa, one in Australia. It's been on a roller coaster ride where it started at this price, £1.10-ish, rose to 15.80, and dropped to £3.60. So this has gone like the Grand Old Duke of York, up and down. And where will it go next? Well, that's what this article's about. So what I've done is I've put together a couple of thoughts around this. So my rationale is that, as I say, it's got quite a number of assets. Thermal coal is counts for over a third of global power generation. So even though coal is on the decline in percentage terms, that doesn't mean that there's not an opportunity here. It's at a huge discount to its net asset value. It's also very strong, has strong cash generation. About 3/4 of its market cap is covered by cash, which I just find an incredible number. It's got growth potential. It's investing back into itself to reduce its own costs. And yeah, so hopefully I can sort of show you the reasons why I believe this has some strong, I believe, strong prospects. So as I say, it's been on a roller coaster ride. This is back in 2022. Now this was also mirroring the fact that coal prices shot up in 2022 and have since fallen back down. I do cover that in the article, and it's this. Let's see, it's this chart here, so you can see that the price of coal rose to quadrupled, and of course, when the price of a commodity quadruples, profits more than quadruple because of the nature of leverage. So you're essentially increasing your profits by a factor of 15 times, something like that. Of course, yes, it's fallen back, and we can see that it hit a low here of 90, and it's bounced back to 109. This is US dollars. And this is the trading economics price. We don't have a single simple price. There's variations because of variations to calorific value of, so 6,000 being a sort of a benchmark energy value. So if you've got inferior coal, then you can expect to be discounted. If you've got pollutants like ash and sulfur, you can expect to be discounted. So in the case of it's South African coal, it gets discounted by about 15%. In the case of its Australian coal, we're talking zero. So it just depends. But it's interesting because the South African coal is cheaper to produce. So these costs here are based on the 2025 outlook prices. That's what I've used. That's the price for Australia. So actually, once you factor in this 15% discount, that actually boosts this back up to 63. So it's 63 if you factor in the discount as part of the cost of sale. For me, that's a helpful way of looking at this, and it also means that I can just produce a profit model. So the profit model I produced is this. So at the $109 $50, and I've turned all of this into pounds just again, so it's easy to understand. So essentially, 109.50 equates to £80.51. The operating cost based on the guidance is £63, but then there's other costs, okay, which equate to about £11, just over £11 a ton. Uh, as I say, it's sitting on a massive cash pile, huge cash pile, and that cash pile, it's about £2.70 a share. Um, that cash pile is generating the equivalent of £2.08 a tonne in terms of income. Uh, in absolute terms, it's 36 million, 36.8 million. So over here, what we see, these are the absolute terms. So revenue was 1.4 billion, operating costs were 1.1, and so on. So based upon these numbers and taking the tax at 30%, which is previous sort of years of tax, so that seems a reasonable thing. What we're talking about here is the forecast or the outlook for 2025 looks to be something along the lines of £5.94 per tonne. Now, obviously, this is a slightly simplified model in the sense that, of course, there's some level of fixed costs in this number here. So if your production is greater or less than this, 17.7 million tonnes, then of course that price would go up or go down. In terms of outlook, the outlook appears to be that production will, if anything, increase slightly. There's a couple of capital projects that they're working on, but what you can see is that that would generate a 105 million net profit after tax, and on a market cap of just over about 440 million. You're looking at a price earnings of 4 times. But this is assuming that this price, 109.50, remains static. Well, what if it doesn't? So looking at the outlook, it looks that, if we saw something like a 40% price rise, then the economics change substantially. We're then looking at a price earnings of less than one. So think about that. For every pound you invest, it's generating over a pound of net profit. Now, will all of that come back to you as a dividend? No, probably not, because they're investing back into the business. There's various other things going on with the cash. But would quite a chunk of that come to you? It has in the past. The track record with Thungela, let's just sort of take you back to the presentation, is that, and I'll come on to the past. Let's just cover off a couple of other things now. Their slide presentation deck, the latest, is dates back to 2020, which so this you can see here. This is based upon 2021 cost curves. Now, the cost curves have changed dramatically. I would say these guys are no longer. You can see here. This is sort of at below 50 per ton. You can see from my model that is now a lot different. £63 would be about 84 dollars. Something like 80. It was no, sorry, yeah, it's about $80. But these costs are going to be inflation across the world. That energy costs have gone up and labor costs have gone up and so on. So back at this point in time, it was second quartile. So these ones are the lowest cost mines in the world. See, Zibolo is one that is lowest cost. The others that you can see here, the red ones are second, and then we've got one up here that is then in the fourth quartile. But that's kind of generally the mines are low cost mines, and also to say that Thungela have invested back into the mines to drive down the production cost. That's the other thing. There's a couple of capital projects that are going on as well. So yes, again, this is back in 2020. This is the forecast for 2030. when I looked at the latest numbers, this has actually increased. The latest numbers being 2023 numbers that I could obtain. This has actually grown, incredibly grown to 35.5%, okay, as a share of power. This, meanwhile, has shrank. So the forecast in 2025 for 2030 is now that this will be a 28.4% share. Okay. Uh, but this number here, it's interesting, this number here has grown substantially. In other words, what they were predicting back in when they produced this presentation deck as what the demand would look like for world energy. This is power, global power generation. So this is, just to be clear, this is coal that gets turned into electricity. Okay, so global power generation is world electricity generation, essentially terawatt hours, obviously being um, uh, electricity. So obviously, yes, renewables are growing fast, and that percentage, if anything, is far larger, or going to be far larger, or predicted to be far larger. But that doesn't take away from the fact that in absolute terms, and I might need to revert back to my um, this part here. It's very interesting that when you actually look in absolute terms, that demand, again, this is IEA 2024 data, that between 2024 and 2027, that demand for coal is going to grow by over 100 million tons per year. And that's based upon these countries adding 250, 249, while EU, US, rest of world reduce their coal. So some are increasing, some are decreasing, but overall more are increasing their consumption than decreasing. And you can see it there. Those are the reducers, those are the increasers, and it's only a slight, that 100 is only a slight increase, but it's an increase. And that's just to 2027. When I looked at the numbers to 2030, see, I've got it in here somewhere. Yeah, so the forecast energy consumption in 2030 is forecast to be 39,000 terawatt hours. So coal demand under that scenario, that 28.4% share of that larger number compared to that smaller number in 2023, okay, so there's a 30% increase to power generation by 2030. Well, that means coal is actually increasing to 2030, okay, incredibly. I'm not saying it's right, I'm not saying it's the way it should be, but it's the way it is. So what do you do about it? As an investor, you have to make a decision. You can sort of say, well, I'm going to take a moral stance and not invest into a supplier that's causing ecological damage, to the environment, blah blah blah. Or you can say, well, the demand is there. Blame the demand. Don't blame the supply. Is it the smoker or is it the cigarette manufacturer you should blame for the incidents of health um, problems through smoking? I mean, obviously that's just a moral dimension, isn't it? You could say, well, I'm going to take a moral stance against investing in tobacco, or you could say, well, if people want to smoke or decide to smoke, well, that's a demand, and somebody needs to supply that. So I'm not going to take a moral stance in this video. It's just simply to say um, I'm looking at unloved value, and the unloved value here is extreme, absolutely extreme. And for it to have dropped, I mean, yes, for it to have dropped from its 2022 high, when clearly it was well, I mean, there was very ambitious prices, let's put it that way. But for it to have dropped 75% to the point where uh, at today's price, that it would essentially, the returns, it's a price earnings of 5 times. Um, and I think there's a lot of evidence to suggest that where you've got increasing demand, reducing supply, because that's the next thing. The, the reasons for reducing supply are kind of several fold, really. Falling supply. You can see here, all of these countries are reducing their coal, or forecast to be reducing their coal output. Again, this is IEA numbers. India, the bit in blue here, is planning to increase its coal production, and this is into domestic supply, because you can see it here, 107 increase in demand. Okay, the Indians are building more power generation, coal power generation. um, that that is sort of then being met by increased supply in India, so trying to sort of use their domestic resources to satisfy domestic demand, which again, that, I suppose that's logical, isn't it? But overall, obviously, the reductions are greater than the increases. So this one's just below 200, decreases are well over 200. Okay, so you've got kind of, well, it's difficult to imagine a world where prices would plummet back down when you've got increasing demand and reducing supply. That just wouldn't make any sense from an economics point of view. But it gets even potentially more exciting, because obviously this was back in 2024 that the IEA produced these forecasts, and they are just forecasts. And of course, this red Russia, this little red strip here, is um, the decline in Russia, and you can see there was a slight decline here, and of course, there's sanctions. There's various reasons why the Russians are in trouble. Obviously, a lot of the people that would perhaps be mining the coal are now sort of frontline Ukraine war. Lots of reasons that there's disruption to 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 Russian supply. Um, Interesting to see that the Russian government. This is a news article from June. For the end of May, Reuters, basically that the Russians have basically stopped taxing their coal producers, because the coal producers are in serious trouble. 30 are at risk of bankruptcy, facing all kinds of challenges. Profits have collapsed. I mean, that is not a world and a scenario where Russia is in any situation to increase its own supply. It it'll be lucky if it can keep its own supply going. That we could see some, and it's interesting that when you look at the cost curves of these cost curves here, um, that that a lot of the low cost production is actually Russian. So I've got it somewhere in all of this. Is Here we go. The red ones being Russian. Okay. Look at all of these red ones that are, well, I mean, obviously these ones are in the first quartile. These ones are sort of probably third quartile, and then there's a couple that are fourth quartile. I mean, the fourth quartile ones, you could sort of say, well, potentially forget it. These ones are toast. Like everything up here is toast. Obviously, that 109 is slightly above there. So pretty much that point there is 100. So everything going below that is in trouble. Now, this FOB cost is not the entire cost of running your operation. That FOB cost is that cost there. So as I say, in the case of Thungela's at about 80. So if prices dropped from 109 back down to where they were at the low point just after the Trump Liberation Day, just after sort of early April, then Thungela would be in trouble. It would be breaking even if it were lucky, probably losing a bit of money. But obviously, these guys would be in real trouble, and anything red Russian, I think you could fairly safely say, well, they're going to be bankrupt because their costs are too high. They're disrupted by sanctions. Even if the Russian government's stepping in to help, by reducing export taxes and so on, there's a limit to what they can realistically do. And some of these would just, so in other words, you would see quite a lot of supply destruction. So what I'm trying to say, and what I'm hopefully conveying here, is that I just can't see that there's an awful lot of downside from where it is today, that if coal prices dropped, that supply would just destroy itself, and therefore the price would not continue to drop. The coal price would bounce back due to supply destruction. Now, would that be instantaneous? Well, no. Um, but would it persist? I mean, bearing in mind that Thungela has got very deep pockets with lots of cash in them, remember, £2.70 per share, so about three quarters. In fact, let's just sort of put this up on the screen. So this is their 2024 accounts. So what we're talking about is that they've got, now this is in um, South African Rand, so they've got 10 billion Rand, okay, and 10 billion Rand uh, is 417 million pounds. Okay. Now, of course, yes, they got that, but then they've also got liabilities. So, obviously, some of these, like the environmental liability, I mean, that's not today. That would be at some time in the future. Um, so obviously, here you've got trade payables, and here you've got inventories and receivables. So, I mean, yes, you might want to earmark some of that cash to say, well, okay, my receivables are lower than my payables, so I'm going to